Welcome to the CFA Level 1 presentation on equity valuation. So let's just get a general overview first. Some basic terms that you've heard before. When we talk about equity valuation, there is a concept of market value, intrinsic value, and fundamental value. The market value of a stock is simply the value at which it is selling in the stock market. So if currently shares of Hubco are selling for say 40 rupees in the market, then that is the market value of this share. Intrinsic value and fundamental value, these are synonymous. And this, as we've seen before, intrinsic value is the value that you think that the stock should be trading at. And using the models that we'll talk about later, let's say that you come up with an intrinsic value of 45 rupees. So this is saying that based on your analysis, the value of this stock should be 45 rupees. That is what we call the intrinsic value. And obviously, if the intrinsic value is much more than the current market value, then it would be logical to buy this share. And if the intrinsic value is less, then you should either sell or go short. Now, I made this rather simple, saying that if the market value in my case is 40 and the intrinsic value is 45, we should buy. However, before buying, we should consider a few factors. One has to do with the percentage difference. In my example, there is a substantial difference, but what if there is just say a 0.01% difference? Then does it make sense? Probably not. Or actually, when market value is equal to intrinsic value, that means that the return that you can expect on the stock is simply the regular return or the required return for that stock. So for a long-term investor who is happy with that required return, it might still make sense to buy a stock where the market value is equal to intrinsic value. However, if, as in this case, market value is less than intrinsic value and you are buying because of this difference, then the factors to be considered are listed here. So one, you look at the percentage difference. If the percentage difference is very small, this might go away in terms of transaction costs. So if your transaction cost is more than this difference, then obviously it doesn't make sense to buy if you are simply buying because of the difference between market value and intrinsic value. Another important factor is the confidence that you have in your model. So how confident are you in the model that produced this price? If you are not very confident, then again there is a question mark as to whether you should buy. Model sensitivity to assumptions. If your model is very sensitive to assumptions such as the growth rate or the future dividends, then clearly there is a question mark, because if your assumption about growth is a little overly optimistic, then what happens? So then in this case actually you should try a few more assumptions and see what happens to the intrinsic value if you use other assumptions. And if you consistently get a value above market value, then it might make sense to buy. Fourthly, look at the number of analysts who are tracking this stock. If the number of analysts tracking the stock is high, then it is highly unlikely that there is a major inefficiency. So then it is more likely that there is something wrong with your model. On the other hand, if a given stock is not tracked too much by many analysts, then there is a higher chance that there is an inefficiency that manifests itself in the form of a difference between market value and intrinsic value. And finally, even if you are convinced that the intrinsic value is more than market value, the question is whether you believe the rest of the market will agree with you in the long run. If you think that the rest of the market will not agree with you anytime in the near future, then you can be perfectly happy that the intrinsic value is 45, but if the rest of the market is comfortable with 40, then it is possible that this price of 40 remains 40 for a long time, and in essence you do not benefit from this difference. So let's talk about different categories of equity valuation model. Here I'll just give you an overview, and then in subsequent slides we will get into details. So one category is the discounted cash flow method, and in discounted cash flow methods essentially we are forecasting future cash flows and then discounting them to get a present value. These two subsets simply are based on what cash flow we are discounting. As you can imagine, in the dividend discount model we discount future dividends. In the free cash flow to equity model we discount the free cash flow to equity. With multiplier models we use multipliers such as the price earnings ratio, and here there are two subcategories: the multiplier method based on fundamentals and the multiplier method based on comparison. And finally we have asset based models. Let's now talk about one of the most commonly used models, which is the dividend discount model, and we'll do several simple examples of this. Let's say that you buy a given share of stock X, and let's say that you buy it at time 0, and at time 1 you expect a dividend of 10, plus you expect to sell the share for $100 at the end of year 1, so that is this point. And let's also say that the cost of equity that you are using is equal to 10%. So with this one period model, the value of the stock should be equal to the present value of the future cash flow. The future cash flow is simply 110 after 1 year, and you discount this at 10%. So you simply discount at 1 plus the interest rate, which is 1.1 raised to the power of 1, because we just have one period. So this is simply 110 discounted at 10%. So this is equal to 100. So that is pretty straightforward. With the multiple period model, the idea is the same. Here let's say that now you are going to again invest in stock X, and let's say that you expect a dividend at the end of year 1 of 10, and at the end of year 2 you are again expecting a dividend of 10, plus you expect to sell the stock for 100. Now in this case the value of the stock will be equal to 10 divided by 1.1. Again we are assuming that the cost of equity is equal to 10%. So the value of the stock is 10 divided by 1.1 plus 110 divided by 1.1 squared. An important point to note here is, what do you do with a dividend that is received at time 0? And the critical point is that the dividend received at time 0 is not included in the stock price. So when you are told that say D0, which represents the dividend at time 0, is equal to 10, then that dividend is not part of the share price. You can imagine that if the shareholder has a left pocket and a right pocket, then we are talking about the valuation of stock X, which is say in the right pocket, and in his left pocket is a dividend of $10, which makes the shareholder happy because he has that cash, but that 10 is not part of the valuation of the stock. The valuation of a stock is based on present value of future cash flows. So this point is critical, and it will keep showing up. Next, let's talk about a constant dividend. So now let's say that you have a stock that pays a constant dividend of $10. So dividend of $10 at time 0, $10 at time 1, $10 time 2, and so on. And let's say again that the cost of equity is 10%. So what's the present value of this share? And in a number of questions related to preference shares, you might see something like this. The value of this share would be equal to D1 over the cost of equity. Again, notice that we do not count the first dividend, the dividend at time 0. We are starting with the dividend at the end of year 1. So the value is equal to D1, which is 10, divided by the cost of equity, which is 0.1 or 10%, and this gives us a value of 100. So you saw this in quant, and all we are doing here is taking the present value of future cash flows. The cash flow here that we have is simply a perpetuity, and if you remember, the formula for the present value of a perpetuity is given right here. Next, let's talk about constant growth. So now let's say that the dividend at time 0 is 10, and let's say that this dividend is growing at 2%. So 10 growing at 2%. So our growth rate is equal to 2%. The formula for this situation is as follows. So the value, or the present value of future cash flows, is equal to D1 over R minus G. You have seen this in corporate finance, to some extent you saw this in portfolio management, and now you are seeing this again. So clearly this is important. This is also called Gordon's constant growth model, where we are assuming that the dividend is growing at a constant rate. In our example, the constant rate is 2%, and in our example, the cost of equity, RE, is still 10%. So the value of this share should be equal to D1 over R minus G. D1 is equal to 10 multiplied by 1.02 divided by R, which is 0.1, minus G, which is 0.02. So you can do the maths and come up with the value of the share. But here again, note that we did not use this dividend D0 in our calculation, but the dividend D0 was useful in terms of figuring out D1. So this number this number that we calculate gives us what the share price should be at time 0. So what are the assumptions necessary here? Clearly we need an assumption for the growth rate, and then we are assuming that the growth rate is constant. We need to assume a value for D1, and we need to figure out a value for cost of equity, and later on I'll talk about how we come up with these values. It's also important that R minus G is positive. If R minus G is not positive, then clearly this model does not work. And if R is greater than G for some period of time, then we use a slightly different model, which I will talk about soon. In fact, I will talk about it right here with the example of supernormal growth. Now, how does this work? Let's say that you have a situation where the dividend grows dividend grows at 20% for 3 years, and then it grows at 2% after that. So this is called supernormal growth, because for a short period of time we have like exceptional growth, and after that we slow down to a regular constant rate of 2%. And again, assume D0 is equal to 10, cost of equity is 10%. The first thing that we do is create a timeline. So at time 0 we have a dividend of 10. At time 1 we have, since this is growing at 20%, we have 12. And then at time 2, 12 is growing by 20%, so we have 14.4. And then at year 3, so remember for 3 years we are growing at 20%, so at the end of year 3 our dividend will be 17.28. And after that we are growing at a constant rate of 2%. Now the way we solve this problem is to calculate the value at time 0, we have to get the present value of all future cash flows. Remember, once D0 has been used to estimate the future cash flows, then you do not include D0 in your calculation anymore. So in this case, notice that at time 3, the value of all these future cash flows, so what we need to do is actually at time 2, so at this point in time, the value of the share, or the present value of all subsequent cash flows, so I can say the value at time 2 of all these cash flows can be given by D3 over R minus G. So value at time 2 of all the stuff that I have put in the oval is equal to D3 over R minus G, which is equal to 17.28 minus 17.28 divided by R, which is 0.1, the 10% cost of equity, minus the constant growth, which is 0.02. So this number is equal to 216. So 216 essentially represents, at 216 at the end of year 2, represents all these payments over here, or all these dividends over here. And that means we can remove all these dividends and replace them by one number, which is 216 at the end of year 2. And we've used the constant growth model because from this point onwards the growth is constant, and the formula gives us the present value one period before the first dividend that we use. The dividend that we've used is 17.28, which is D3. One period before that brings us here, end of period 2. So at the end of period 2, the value of all these cash flows scrunched up into one number is 216. Now we have a very simple problem. So we have a cash flow of 12, which is being received after 1 year. So we have to calculate the present value of that, which is 12 divided by 1.1. And then at the end of year 2, we have two values, 14.4 and 216. So the total number that we have at the end of year 2 is the sum of these two numbers, which is 230.4. So all we need to do is discount 230.4 back 2 periods. So that should give us 230.4 divided by 1.1 squared. So then we calculate this number and this number and add the two, and that should be the value of our stock. Make sure you understand this. There will be several problems in the curriculum as well as in your study notes where you are given a situation such as this. Once you've understood it, make sure you practice it a few times. Now let's talk about the other discounted cash flow method, which is the free cash flow to equity method. When do we use this? We use this for companies where the dividend is either non-existent or a very small percentage of the overall earnings, or if the dividend is not predictable, especially if you have a growing company. So there are several cases where the dividend discount model cannot be used. In that case, what you need to do is, for a given company, instead of using dividends, you forecast the free cash flow to equity for period 1, free cash flow to equity for period 2, and so on. And then we simply take the present value of the free cash flow to equity. And all the sorts of examples that we just saw with the dividend model can still apply over here. So for example, if you have a constant free cash flow to equity, then the present value will simply be equal to free cash flow to equity at the end of period 1 divided by the cost of equity. If you assume that the free cash flow to equity is growing at a constant rate G, then the present value will be free cash flow to equity at the end of period 1 divided by RE minus G, and so on. So the present value of the whole company, or actually the present value of the equity of the company, is going to be equal to the, essentially, let me say this again, the value of equity for the company is simply the present value of all future FCFEs. And obviously you need to figure out what free cash flow to equity is, and the free cash flow to equity is what you've already studied in FRA, but just to refresh your memory, I will tell you again what this is. Conceptually, this is the money that is available to the shareholders, and the value there are 2-3 formulas. The ones that you need to know are as follows. So free cash flow to equity is equal to the net income plus depreciation, because depreciation is not a cash flow, so we add it back, and then minus the increase in net working capital. So increase in net working capital minus the fixed capital investments, and minus any debt repayments, and plus any new debt issued. Sometimes this part is bracketed together and called net cash flow through debt, but this is fairly self-explanatory. So free cash flow to equity is your net income plus the non-cash charge of depreciation minus your investments in working capital minus your investments in fixed capital minus any debt repayments plus any money that you raise through debt. So this is the free cash flow available to the equity holders. You project this into the future and calculate the present value. That gives you the value of equity. A shorter way of calculating free cash flow to equity, if you have the cash flow from operations, then that is simply equal to your cash flow from operations minus your fixed capital investments plus your net borrowing. So this should be a refresher for you, because you've already studied this in your financial reporting and analysis segment. Now, in most of the models so far, we have used the cost of equity and we have used a certain growth rate. How do we estimate these numbers? The way we estimate the cost of equity is using CAPM, or capital asset pricing model. And again, you've seen this before, but as a refresher, the cost of equity using CAPM is equal to the risk-free rate plus beta, which is a measure of the systematic risk of a stock, times the market risk premium, which is the expected return on the market, minus the risk-free rate. And you've seen this before. So if you are given the risk-free rate, the beta, and the market risk premium, then you should be able to calculate the required return, and that required return is what you use in all the previous calculations. So that's the rate at which you discount future cash flows. To estimate your growth rate, you use the formula growth rate is equal to your return on equity times the percentage of earnings that are retained, and that's also called retention ratio. You've seen this before, but retention ratio is the percentage of your earnings that are retained into the company. So if a company makes $100 in net income and retains $60, then the retention ratio would be 0.6. The return on equity is net income divided by equity at the start of the year. So if that return on equity is 10%, then the growth rate would be 10% into 0.6, which is 6%. And this obviously is a estimate. The way you can think about this formula is clearly a company that has high return on equity will have a high growth rate compared to a firm that does not have a high ROE. So it makes sense that there is a positive relationship between growth and ROE. Similarly, companies that have high retention, so companies that reinvest earnings back into their operations, will have a higher growth compared to companies that do not reinvest money. So if the retention ratio is very small, then one can expect the growth rate to be small. Bottom line is, you need to know this formula. So growth rate is equal to ROE times retention ratio, and you have seen this earlier in corporate finance also. One minor twist on this, sometimes just to trick you, the CFA question might give you what's called a payout ratio. So if the payout ratio is 0.4, then make sure you do 1 minus the payout ratio to calculate your retention ratio. So your retention ratio would be 1 minus 0.4, which is equal to 0.6. Now the longest sort of question that you can get with all this data is, you might be given a company for which they've given you the beta, they might give you the risk-free rate, the market risk premium, the ROE, the payout ratio, and they might give you D naught, and you will be asked to find the value of the share. So the way you find the value of the share then is going to be straightforward. The value of the share is equal to D1 over R minus G. D1 you calculate by doing D naught and growing it at a growth rate of G. G you will calculate using ROE, which is given, times the retention ratio, which you calculate based on the payout ratio. Then the cost of equity will be calculated using CAPM, and they will have given you the risk-free rate, the beta, and the risk premium, and growth rate we've already seen calculated here. So it is quite easy once you understand all the formulas given over here. So the three critical formulas, just to put them all on this page, in fact I already have them on this page. One is the CAPM formula, the other is the growth rate formula, and the third is the dividend discount model formula, where we use D1 over R minus G. So these three formulas are extremely important, and I can almost guarantee you that there will be a few questions related to these formulas on your exam.